There's a reason why only 1% of traders get and stay rich. And it's not because of hard work, and it's certainly not because of luck. Money flows in society in a very particular way. And in this video, I'm going to show you how you can have money flowing straight into your pockets. Now, there's a great little quote that I'd love to share with you. A very rich person once said, if you took all the money in the world and divided it equally among everybody, it would soon be back in the same pockets it was before. And there's a very particular reason for this, which I'm going to elaborate on, and then I'm going to show you how we can use this principle, this idea of how money flows to your advantage as a trader. Okay, so every human being has a set of values or priorities that they live by moment. And your value system or your priority system is what you'll spend money on. Now, if you have a very high value on your family and relationships, and you have a very high value on, taking them out for nice dinners and on nice holidays or vacations and nice trips, the moment money comes into your pocket and you see money there, in your perception, in your mind, because you have such a high value on family and relationships and showing them a good time, in your mind, the cash form that the money's coming into your bank account with, in your mind, the value on family and relationships is higher than saving the cash. So therefore, the moment the money comes in your mind, family, relationships, dinners, trips is more valuable in your mind. You're going to put the financial cash towards that. And you're going to spend money according to what you value. Now, the simple answer, which we're going to elaborate on in today's lecture, and it's really the underarching principle of today's masterclass, the reason why, if we distributed all the wealth in the world among everybody equally, the reason why it would end up in the pockets of those certain few that had it in the first place is because those certain few have a high value on what actually creates wealth, on the action steps that create and keep and compound wealth. They have a higher value on those rather than anything else. So, like I'm going to show you in a second. Okay? So if money comes into your pocket and you have a very high value on family relationships or dinners or holidays or clothes or really anything other than saving and investing your cash, then the moment money comes in, that money is going to be spent according to what you value. Because in your mind, it's more valuable in those forms than it is in the cash form. Okay? And you may go and have a nice dinner at a very fancy restaurant. And maybe the owner of that restaurant has a very high value on a new watch or a nice tuxedo, a new suit, right? And that's the owner of the restaurant's highest value. So the moment the cash comes into the business and into the owner's pocket and the owner gets the share, that owner is then going to go spend money according to what they value, which is a watch or a tailored suit or a new tux, whatever it may be. But the point is that we all spend money according to what we value. And maybe that owner goes off and buys a nice suit from someone who owns a nice independent tuxedo shop, where he goes and gets his suit tailored and he has now a beautiful suit. Let's say the owner of this tuxedo shop has a very, very high value on 1, saving, 2, investing into income producing assets, and then 3, a very high value on letting and continuously doing that, continuously saving and continuously putting more into income producing assets and watching his investments compound. And let's say that individual has a higher value on doing those specific action steps than anything else, then guess what? The wealth isn't going to flow to someone else. The wealth is going to stay with this individual and compound. And that money is going to grow. So money flows in society from those who value it least, and it flows from these individuals to someone who values it a little bit more, to those who value it most, and has money, but specifically the action steps that go towards generating wealth highest up on their list of priorities, list of values. So money flows in society from those who don't have a value on saving, investing, and compounding their wealth to those that do. Because the moment cash comes into your bank account, into your pockets, it's going to be spent according to those things you value more than cash, investments, compounding. And that's not a right or wrong thing. There's no right or wrong here. But most people do want to generate income, and they want to generate some level of financial independence. So then it's smart to have saving, investing, compounding high up on your list of priorities, a list of your values. Okay, and this is what we're going to talk about today and what we're going to elaborate on, because this principle is overlooked by traders, and a lot of traders make a lot of money, but they have a higher value on other things, and they go off and spend on those other things. And at the end of the year, at the end of 10 years, they have nothing to show for it financially in the financial form, because they didn't value the action steps that actually go towards accumulating, growing, compounding your wealth. It's important to note that your life demonstrates what you value. If you say that you value making money, but your actions show that you value going out on nice dinners and spending money and buying new clothes and buying new watches, then you don't actually value value wealth creation. You value what having money can buy you, but you don't value wealth creation. So you want to be looking at your actions, not at your words. There's a big difference between what you say and what you do. Your life demonstrates what you value. Your actions demonstrate what you value. Because if you truly valued something else, your actions would show that and you would do that. Okay? So the reason why only 1% of traders are rich, and when I mean are rich, I mean get and keep money, is because only 1% of traders truly have a high value on the action steps that will get them and keep them and help them compound their wealth in the first place. And we're going to elaborate on what those specific action steps are. Okay? Now, through my last 8 years of study of the financial markets, of human psychology, of working with many, many clients, of seeing my own trading and my own business growth, etc., there are specific action steps that you can do to help you become a consistently profitable trader, to generate income from the markets, as well as help you compound that money and let it grow into the future. And we've discussed in previous lectures that there's a positive sum source of income. There's also a zero sum source of income. It's wise to have both. One of the easiest ways for traders to transition from zero sum to positive sum, and by the way, trading is a zero sum, it's a win-lose model, whereas a positive sum is a win-win model. One of the easiest ways for traders to transition from zero sum to positive sum is to start managing other people's money through a prop firm or through a private investment deal. I'm not sure, but however that's structured is going off and managing money. Okay? So when we talk about having a high value on the action steps that will help you get and keep money as a trader and generate wealth as a trader through the zero sum source, there are a few highly specific action steps that I've identified as the 4 steps to consistent profitability, that if every trader implements and follows exactly what I'm going to share in this lecture, they can have consistent profitability. The first one is you need to identify, either by learning or creating, an edge. You need to have an edge in the market. You need to have a specific strategy that gives you an edge in the market. You need to have a specific risk management model that gives you an edge in the market. So you know if you consistently execute on that edge over a larger sample space, you're going to end up profitable. You may not be profitable in each individual trade, but you're going to be profitable over a larger sample space. So the first thing every trader needs to do to help them become rich is to identify by either learning or creating a specific edge. You can't overlook that step. If you don't have that, doesn't matter how good your mindset is, doesn't matter how in alignment your priority system is, you're going to come to the market and do action steps that aren't proven to reap you profitability in the first place. So you need to start by having an edge. And let me elaborate on this a little bit more. Ways you can identify and create an edge is by studying and learning far and wide. It may take a little bit of time, or you may get lucky and stumble across your edge initially. For me, I learnt my edge initially. I knew exactly how I wanted to trade initially, but then I went on a little bit of a wild goose chase to find things that I thought were better for 4 or 5 years until I came to the realization that that initial edge I learned was actually what was best for me. So you can learn far and wide, and you can study to identify and create an edge. And it's probably a good idea to study under many different people, study many different ways to trade, so you can find a way that's suited for you, for your personality and your risk appetite. And then you want to go off and test this edge in previous market data. You may do this over a 12-month period, testing 12 months of data, and then go sporadically through different market conditions to see if your edge holds up, to test your edge and to see if it's profitable or not. And then to run a double blind test on it to make sure you're not getting caught up in confirmation bias, to go back through that data and find every single reason why your edge won't work and see where it's vulnerable, and then put action steps and procedures in to mitigate those risks and to mitigate those drawbacks. Okay? So mitigation here. And then at the end of that, you're pretty certain that if you execute on this more times than not, you're going to end up profitable. Because through a law of self-fulfilling prophecy in the market, human nature repeats itself. The laws of supply and demand replicate. So if you're certain that this is going to happen more times than not through previous data, and you have an accurate view of that data because you've done a double blind as well, then you can be quite certain that these things are going to play out in the future. And you tie in good risk management, and you try to, in your edge, maximize your wins and minimize your losses, then you got a profitable edge there. Good. And when you're certain you have a profitable edge, and you've got no doubt in your mind, you then want to put that edge into a mechanical trading plan. Because it doesn't matter how good your edge is, if you can't consistently show up to the market and execute and adhere to that edge, you're not going to have consistent profitability. These are the 4 steps to consistent profitability. So identify an edge, then put it into a mechanical trading plan. Mechanical trading plan looks like this. I know exactly what my entry is. If this, and that are present, that's a good area of value for my entry on the higher time frame. And then if those things are present, I'm going to go down to the lower time frame, for example, to have a look at my entry criterion. If this, and that are now present on the lower time frame, after those factors were present on the higher time frame, I know I have a good entry. I've got a good entry point. Good. You want to make that mechanical in black and white. And by the way, I've got my 6-figure trading plan template in the description below. So if you don't already have a trading plan that's clearly outlined, or yours is a little bit general or broad, or you're missing things from your trading plan, I outline every single detail that you need in that trading plan. It's in the link in the description. You don't want to miss anything. And if you have that tool in the description, it's going to be very easy to fill in. Okay? So you want everything that your entry needs. Then you also want to know your management. You want to know where you're putting your stop loss initially. You want to know when you're trailing to break even. You want to know how you're actively managing. You want to know where you're taking profits. You want to cover each of these things and make those black and white based off the edge you've identified, because you've already tested this. And then you want to have a proper risk management protocol. You want to know exactly how much you're risking at every stage, even if you go into drawdown, if you go into profit, or if you've taken 1 or 2 losses for the day. You need to know exactly what you're doing in every scenario. And you want to create rules, black and white rules. Now, will you figure all this out on the first go? Probably not. Depends how experienced you are. Depends how much experience you have in the markets. But if you're relatively new, probably not. You'll have something now that you can be certain in, at least initially, but you may have some gaps. And over time, as you continue to trade, as you continue to review, do your analysis every 3 months, you're going to continue to fill in those gaps and make refinements. So after you've identified your edge and put it into a mechanical trading plan, step number 3, think about it. You've got an edge now, you've got it in a trading plan, you know exactly what to do. Really, the only thing that's going to stop you from sticking to that is your mindset. And more specifically, it's fear and greed. Because if you're fearful in the market and you're in a state of lack and scarcity and fear, if the market presents an opportunity to you, you're not going to execute according to your trading plan because you don't want to experience or relive the pain you've just lived through a previous loss. Or if you're greedy in the market, then you're going to puff yourself up, minimize the risk in the market. You're going to think you know better, and you're going to think you can predict what's going to happen next in the market. And you're going to force your ideas, and you're going to get humbled because the market's never wrong. So as a trader, once you have an edge in a mechanical trading plan, in order to stick to it consistently to reap consistent profitability, you need to manage fear and greed. And there are two ways to do this. Firstly, by using the Bulletproof Your Mindset tool in the description. This tool, what it's going to help you do, it's going to guide you to bring to surface any expectations you have on the outcome of a trade. Because it's the attachment to a certain outcome in your mind that promotes emotional thinking after a trade. If you have a certain expectation on what you're going to get from the market, but the market doesn't provide that to you, you're going to have resentment, you're going to have pain. Or if the market exceeds your expectations, you're going to have this manic pride, elation state. So your emotions as a trader are very highly attached or connected rather to your expectations before every trade. The Bulletproof Your Mindset tool is going to help you become aware of your expectations, ground those expectations with a questioning process to help you be more balanced and objective with your thinking. So you're going to be less emotional as a trader. You're going to stick to your trading plan. You're going to have less volatilities and less stress in your trading. You're going to be making better decisions. So that's what you want to do before every trade. Then after every trade, you want to learn how to get yourself back to a state of equilibrium and state of balance to get out of these volatilities of fear and greed. Greed, fear. You need to learn questions that I teach these questions in the 12-week program to get this state of elation, state of greed, and to learn how to ground yourself, how to bring yourself back down to earth, and how to get yourself back to a state of equilibrium. And when you're in fear, to bring yourself back up to a state of equilibrium. So it's only when you're balanced out of these states of fear and greed can you stick to your trading plan. Because both greed and fear take you away from your trading plan. They skew your perception of risk, and they impact your decision making. They make you irrational. But by utilizing these two mindset tools, you're going to get back to a state of being balanced and sticking to your trading plan. It's very, very important. Now, the fourth step to consistent profitability is now going off and structuring your life, all areas of life, 7 areas of life, to ensure that you're consistently executing on your mechanical trading plan, number 2, with a balanced state of mind, number 3. And it's about doing this over and over, relentlessly, on repeat, until you approximate your edge in the markets. So these are the 4 proven steps to consistent profitability. This is how you generate income as a trader. And then, of course, how you can turbo boost that is through, this is income. And of course, the way you can turbo boost that income is through now putting on a few prop firms and setting up a trade copier for a few prop firms here. So now you're leveraging your 4 steps to consistent profitability. And you're generating higher and higher degrees of income as a trader. Okay? Guarantee if you're not making money as a trader, it's because you're not doing one of these 4 things or more. If you do each of these 4 things to certainty, you'll have income as a trader. And then all you need to focus on is scaling that income with prop firms like Telos Capital and managing your psychology and managing all the subconscious stuff that pops up that's stopping you from feeling worthy of making and holding on to that money. Okay? So mindset becomes an even more important part as you continue to scale up, but it's also important initially. So this is how you make money as a trader. And if you don't have a high value in each of these action steps, then you're not going to do them. So this is where I'm coming back with this little example here. You need to value the action steps that help you make money in the first place. You need to value the action steps and have a high priority on doing the action steps that make you money in the first place. Okay? Now, I talk about a linking process in the 12-week program to help you raise the value of specific action steps. But you need to value each of these action steps to make more money as a trader. Now, the next question is, how do I keep this money? You've made this money as a trader because now you value the 4 steps to consistent profitability, But how on earth am I going to keep all this money I have coming in? I've scaled up with prop firms. I've maybe got, quite a good allocation with Telos Capital. Maybe you have full max allocation with Telos Capital, $4 million in funding. So how do I keep this funding? How do I keep this income that I keep generating? The way you keep the funding is by sticking to the 4 steps. But how do you keep the money, the income you're generating? And it's very simple. You now need to have a higher value on the action steps that help you keep and continue to compound wealth. Number 1, saving a portion of all your profits. Number 2, putting a portion of your profits into safe long-term income producing assets. And then 3, raising the value on this so you continuously do it and you continuously generate more and more income, and you leverage this and you do more of this. You continue to drive this up and you watch your income compound, or your investments compound rather. So when you have income come in, you need to have this structured, otherwise you're going to make money. But guess what? If you don't have this structure, you don't have a value on these action steps, money's going to come in and then money is going to go out on a new bag or something, whatever it may be, whatever you value more than these action steps. So as money comes in, income from your trading profits, you want to put a portion into your savings. You want to put a portion into your taxes. And then when you build up a cash buffer, let's say a 6-month cash cushion, you've maybe got expenses of $5,000 per month. So you've got $30,000 of cash sitting in the bank. Now, whenever income comes in that exceeds that number, whatever spills over, you then put into your investments. Every month, you're buying the same dollar amount of income producing assets. Your dollar cost averaging income producing assets, like a safe investment, like an index fund or something like that. And when you value these action steps, guess what? Money now comes in. If you've structured these action steps, money comes in, and then money doesn't go out to other things, like things that depreciable assets that aren't going to generate income, but money is going to come in and you've got it all structured, and they go into income producing assets, into investments, and you let this compound. You use the 8th wonder of the world, compound interest, and over a long period of time, you now have completely passive income. If this is all automated, it's completely passive in the form of a dividend payout every quarter or every year, twice a year, whatever it is, getting paid out. And initially you reinvest the dividends, but eventually you may want to live off that. And your investments are going to be so big that the dividend payout you get is going to cover your expenses. And then you have financial independence. Okay, but you're not going to get to that unless you value the actual action. This is the point of the video. Unless you value the point of actually going off, saving, putting portion of your profits into income producing assets and letting that compound, you're not going to get to that state. The reason why, like that very rich person said at the start of this video, the reason why if money was distributed in society and everybody got an equal share, it would end back up in a certain few hands, is because the certain few hands have a high value on the action steps that help them attract and keep and compound and grow money. And those who put that money back in their pockets have a low value in doing that, and they have a higher value in spending their money on depreciable assets. So you can start to shift where you end up financially by shifting where you associate value and your priorities and the action steps you do day to day. Okay. So hopefully that was insightful, but we've got more to cover. The other little component to this is the positive sum income. These individuals have a high value on going off and serving individuals, creating a product or service that serves more and more people every day, and it serves people. And they charge in fair exchange, and they make income, and they focus on serving and charging in fair exchange, producing income, And then they go into the action steps we covered here. They save and they invest in income producing assets and they let it compound. So my point of today's video is, if you want to be part of the 1% of traders who are rich, who get and keep rich, you have to value the action steps that are proven to get you there in the first place. The 4 steps of consistent profitability will get you rich, but then to stay there, you need to take a portion of that income, save it, and invest into long-term investments. Think about it like this. I really like this analogy here of how wealth flows in society. And now, that doesn't mean you're not going to have any outgoings. Doesn't mean you're not going to have any expenses. You still got a life to enjoy, but you value savings, investings, compoundings more so than not than the other things. So majority of your money goes into compounding and growing, as opposed to coming in one pocket and coming out the other. Okay. Hopefully that makes sense. I think I've covered everything I want to cover. If you have any questions, let me know. Thank you for watching to the end. Check out the resources in the description and the first comment. They will be useful. And I look forward to seeing you all in the next video.